Hey, how's it going, everyone? Welcome to Dividend Compounders with Cheese. Today, let's go ahead and talk about Starbucks, the mermaid coffee company based out of Seattle, Washington. Right now might be a good or a bad time to jump into Starbucks. And hopefully by the end of the video, I'll develop an opinion of how I feel about this company. In this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or a disgusting, ugly, hideous dividend stock. Unless you're a short, bald man, you've probably heard all of the bad press surrounding Starbucks. Their stock is getting smashed in the shins by investors because there's a lot of fear and doom surrounding the company right now. The sentiment is not good. What exactly is Starbucks? Starbucks is a cafe business that sells made-to-order drinks to customers. However, they're much more than that. Starbucks is a brand, a status symbol, a craving, a third place where people can go to hang out, to work, or to even study. I don't even drink coffee, but when I recognize a good business, I'm intrigued. And let me tell you, Starbucks is a fantastic business, which is why I wanted to do more research about them. And fun fact, one of my MBA friends is actually a product manager at the company, and he is pretty happy from what I can tell. More on this in a little bit, the happiness of the employees. Starbucks recently held their annual shareholders meeting on March the 13th, and yes, I tuned in and listened to the entire thing. The CEO gave a whole speech about how the employees, which they call their Green Apron partners, are the heart of the company. He basically showered the Starbucks employees with gratitude and appreciation for a good 15 minutes. It was pretty convincing lip service. I did not know that there were that many ways to say this. I like you. Please stop protesting or encouraging people to boycott. And he reaffirmed his bold ambitions to bring Starbucks back into the conversation with Domino's and Chipotle. He is laser focused on expanding Starbucks internationally, which, as we all know, China's economy isn't doing too well. And Luckin, their version of Starbucks, is growing by the week. Starbucks also made a call out at their last earnings report that they have reduced their yearly sales forecast because of all the boycotts and workers quitting or getting fired. They missed their EPS expectations and they missed their revenue estimations. Not by a whole lot, but they still missed. So, Starbucks definitely has headwinds, a bumpy road ahead for them. Despite all of this, white women will make sure Starbucks never fails. Their track record speaks for itself if you just look at your screen right now. It's a wonderful business going through a storm. A year or two from now, people will be talking about how they regret not jumping in while Starbucks was going through a temporary speed bump. That's just my personal opinion. And did you know in 20 years, Starbucks actually expanded by pumping out 31,000 locations around the world. They went from 32 countries to now 86. And their revenue? Yeah, it went from $4 billion a year to now $36 billion a year. Don't even get me started on their limited edition merchandise that they release internationally. There is a cult following of people who will buy tumblers from every country they visit because collecting a rare Paris Starbucks cup or a Taiwan cup is a thing now. If you think Starbucks is only about the coffee, your knowledge of Starbucks is very limited, my friend. Without a doubt, there's a growing competition in the fast coffee space, from Dutch Bros all the way to McDonald's. But what will differentiate Starbucks from the rest is employee satisfaction. The turnover rate is kind of high. It sits at around 50 to 60%. But so is every other fast casual service job. But the baristas who have worked at Starbucks for more than a year, yeah, they're genuinely passionate and actually want to be a barista. When you graduate college with a 4-year degree in art history, yeah, you're gonna have an ambition to be a Starbucks barista. So with that in mind, Starbucks is on a mission of working with the unions to increase compensation and benefits for all the employees. I think this is the right move. Sure, it might hurt the bottom line in the short term, but employee turnover hurts more in the long run. Having to train new bodies, interview applicants and whatnot takes time and resources. Against the competition, Starbucks and their benefits package is pretty sweet. Within the financial independence, retire early movement, there's a growing community community of people who believe in barista fire, where after you retire, you work as a barista at Starbucks just for the health insurance benefits, maybe a part-time gig of like 15 to 20 hours a week. All that to say, happy employees are good for business. And that's always been my philosophy as a manager in corporate. Take care of my people and take care of my team, and they will take care of our goals and mission. It has never failed me yet. So if you are in a position where you supervise people, instead of being laser focused on the results, try to develop them, mentor them, and build a genuine relationship with your people. Just trust me on this. What is the catalyst for this company? Starbucks has a rewards program like every other business that convinces you to download a mobile app. Even businesses that have no reason to have a mobile app now have a mobile app. It just takes up real estate on your phone's screen, in my opinion. But anyways, within the rewards program, you can earn stars that can be redeemed for products or food. A way to earn more stars is to load up your Starbucks account with cash. This puts Starbucks into the territory of being a bank, as people load up their accounts to redeem more points. Yeah, I know, that's a far reach, but still, this past quarter alone, over $3.6 billion were loaded onto their accounts or gift cards. And when you think about it, that's a crazy free loan to Starbucks. Sure, some of that cash will be converted right away as transactions, but imagine all of the idle money just sitting in people's Starbucks accounts. Starbucks has a 2.5% dividend yield. Their dividend payout ratio is sitting at 60%. And back in 2015, they paid about 55 cents a share in dividends. You fast forward throughout the years, and now they pay out $2.28 a share. And it's important for me to call out that in 2015, Starbucks actually had a 2-for-1 stock split. So if the stock split never happened, then their dividend payout right now would have been $4.56 a share. Their average dividend growth rate is 8.7%. So when you look at this number, it should be growing at a rate of about 8.7%. And they have been increasing the dividend payment for 14 years in a row. So when I look at their dividend profile and dividend history, I think this is fantastic. I think this is phenomenal. Their dividend payment and growth is healthy. I like what I see. With $10,000 invested in January of 2014 and fast forwarding 10 years later, that $10,000 would now be worth just shy of $30,000. This represents a CAGR of 11% year over year. And during their best year, which was 2015 due to that stock split, they went up by 48%. During their worst year, which was 2 years ago, they went down by negative 13%. And judging by their total performance for the past 3 years, it has been a little rough for Starbucks. However, when we look at their total returns, to see your money go from $10,000 to just shy of $30,000 in 10 years, I still think this is a delicious dividend compounder with cheese. And somebody needs to put a bra on this logo. Next, we are going to be looking at the shares outstanding. Essentially, we want to find out, is the company diluting the shareholders or are they buying back shares? So back in 2009, it looks like there were about 1.5 billion shares outstanding. My goodness. However, after the recession recovery, it does look like the leadership team at Starbucks made a deliberate decision to buy back shares. Because as of today, there is now 1.1 billion shares. So they bought back effectively 400 million shares. Next, let's go ahead and look at some numbers and finances. The first thing we're going to be looking at is the revenue, which we refer to as the top line. So back in 2015, they generated $19 billion. You fast forward throughout the years, and it looks like they were on an upward positive trend until COVID hit. Because in 2020, their revenue went down by negative 11% from the year prior of $26 billion. But $23 billion is still a really good outcome. Since then, Starbucks has been increasing their revenue by double digits. And as of last year, they posted just shy of $36 billion. Let's see if the same story is true when we look at their net net income, which we investors refer to as the bottom line. So back in 2015, they posted $2.7 billion as their bottom line. And as you fast forward throughout back in 2019, their net income dropped by negative 20%. And during the pandemic, it dropped by negative 74% from that number that had already dropped from the year previously. However, in 2021, they were able to rebound and they increased their net income by 350% from the year prior. And then it went down by negative double digits. And then they went back up by double digits. Their net income is all over the place. However, the good news is that their top line, the revenue, is pretty consistent. It's good. Next, let's go ahead and take a deeper look at the technical indicators to find out what the stock price movement has to say about Starbucks. So based on their RSI and trading pattern, I would say that Starbucks is trading at a healthy volume, and there's nothing too unusual from looking at the charts. They do seem to have a line of support at about $86 to $87 a share, with their current RSI at about 45 to 50. It's not the worst or the best time to jump in. It's just really average. And now my most favorite part of the video. We are going to run some valuation models to figure out what the intrinsic price for Starbucks is.
Well, intrinsic value, in other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
And the first valuation model is going to be the multiples valuation. Essentially, we are going to figure out a market-derived price for Starbucks based on their industry peers. So everybody here is in some way or form involved with the fast casual space or coffee. And the median PE ratio is 33.6. Taking that into consideration with their earnings per share of $3.74 a share, their multiples valuation is $125.78. And right now they're trading for $90 a share as a refresher. The next one is going to be the discounted cash flow analysis model. Essentially, the free cash flow growth is going to tell us an intrinsic value price for Starbucks. And as we look at their free cash flow, it's similar to their net income. It is inconsistent and it is all over the place. Sometimes it goes down by double digits, and other times it goes up by 3,857%. However, as of last year, their free cash flow did grow by 48%, and they posted $3.7 billion. That spits out an average growth rate for their free cash flow, 739% year over year. However, that is a really wonky number, so instead we're going to plug in 16.3%, trusting the Wall Street analysts, taking that into consideration with some balance sheet numbers. That is going to give us a DCF price for Starbucks, $98.11, which would be $8 to the upside to the current trading price. Next, we are going to be doing the dividend discount model. Essentially, the dividend payout and the dividend growth rate is going to tell us an intrinsic value for Starbucks. So back in 2019, you got $1.44 per share. And as you fast forward to today, now you get $2.28 a share in dividends. This is an average dividend growth rate of 12% year over year. However, that is a little too optimistic for my taste, so we're going to divide that by 2 and plug in 6% into the formula instead. With a 6% average dividend growth rate going forward, which as we all know, Starbucks is probably going to grow it closer to 11 or 10%, but just to be safe, if we say 6%, then their intrinsic value is $120. And last but not least is going to be the Benny Graham's valuation model. Essentially, the growth rate and the bond yields rate plugged into this formula is going to tell us an intrinsic value for Starbucks. This always spits out the lowest intrinsic value. Is this formula going to prove us wrong? No, $79.38. I can always rely on the Graham's valuation model to give me the bear case for a company. Anyways, that takes us to the conclusion. What is the intrinsic value for Starbucks? Well, that number is going to be $106.03. Let's go ahead and see what the Wall Street analysts think. Now, their 52-week trading range, their low was $89 a share and their high was $115. Wall Street says that Starbucks should be trading for about $112 a share. The low estimation is $95 and the high is $150. So we said $106, Wall Street says $112. So based on everything that we've seen so far. And I know right now in the past couple of years or so, they are going through a storm of their lifetime. So you might dismiss it as saying, oh, there's too much bad press surrounding this company. However, on paper and objectively, although sometimes their net income and free cash flow is a little inconsistent, if you zoom out and look at it from a 10, 20, 30-year horizon, they are headed towards the right trend. So even on paper, I would say that Starbucks is a dividend compounder with cheese. I mean, your initial $10,000 10 years ago would turn into $30,000, right? It just puts the petty issues into perspective when you zoom out. So now that I have concluded that Starbucks is a delicious dividend company, I'm going to try to figure out an acceptable buy price. And to do that, I'm going to want to bake in a margin of safety. That way I don't overpay for the company.
And you don't need a huge margin of safety. You should have something that you always should feel you're getting a little more than what it's worth. And there are times when we've been able to buy wonderful businesses at a quarter of what they're worth.
Now, at its current trading price of $90 a share with a 10% margin of safety baked in, then the acceptable buy price is $95 a share, which would give you a $5 discount to the intrinsic value. And if I were to buy Starbucks at its current trading price of $90, then I would essentially be getting a 15% margin of safety. And I'm going to jump onto my little soapbox because remember, my philosophy is that I am not just buying into a stock. Instead, I think of it as investing into a business that has the potential to have a bright future. And I think right now, Starbucks is going through the worst storm a ship can sail through. However, once they navigate past the hurricane, I think this is going to be a rebound story people will regret not believing in. Even Disney recently went through a period of being oversold and labeled as a value trap. But since then, they have been recovering and they'll probably trade for $130 a share by the end of the year. No, that's not a prediction, but I'm just saying. When it comes to high quality companies with a brand that has an economic moat, the recovery story sells itself. That's all I'm going to say. As Starbucks trades at around $90 a share or even lower at 89 or 88, I will be scooping it up. And that's coming from a guy that does not even drink coffee. I just believe in the business of Starbucks. All that to say, please do your own due diligence and research to figure out how you feel about Starbucks. I did all of this to figure out if I want to buy in or not, and I decided that I'm going to buy in. And I'm saying that you should do your own homework because you might think that Starbucks is a horrible company with ugly finances and numbers. Anyways, I'll talk to you next time. Stay safe, everybody. Dividend compounders with cheese, signing off.